Now that we have a good handle on catalysts for pullbacks and how they fuel internal and external range liquidity and how we can use those for targets as well as justification of fueling moves, we can take this a step further and start looking at specifics within sweeps of liquidity. So again, like we said, liquidity in its simplest form is a collection of orders sitting at various price levels. The orders can be limit orders, stop loss orders, stop limit orders, or a place where there is likely going to be a concentration of market orders that will be executed when price trades near or interacts with a certain level of supply or demand in the market. So a sweep of liquidity, simply put, is when these orders get triggered. These orders triggering can be positions opening and closing. Regardless of what's happening, a surge of volume trading in the market has taken place at that particular level of price, which is fueling movement in the market. There are two types of liquidity sweeps that we should take note of in the market: structural sweeps and reactionary sweeps. Structural liquidity is liquidity that exists around structures that have broken other structures. For example, structural liquidity is defined as liquidity that is below a low that broke a high, or liquidity that is above a high that has broken a low. So if we look at this example, we can see that price is forming bullish structural ranges. You can see that we have a low, we have a high, we have a higher low, we have a higher high. And because this low broke this high, we can see that price has a willingness to trade below the previous low and then continue higher. We can view this in the way of external range liquidity if we'd like, in that we have a large collection of orders potentially resting below this low because it has broken this high. Conversely, if we look at this structure where we're seeing bearish market structure, where we have lower low, a lower high, and a lower low, because this high broke this low, there is a high likelihood that there is structural liquidity or market orders resting above this high. And as we can see, price trades above that high and then continues to trade lower. Again, a concept of external range liquidity to help convey this point further. Now, the second sweep is a reactionary sweep. The key idea behind a reactionary sweep or a subtle sweep is knowing who is in control of the market, supply or demand. Once control has been established, the question that is asked is, why is a level giving a reaction if it's not in control? The answer is simple: to generate liquidity and to be swept to fuel the market. So, if we expand upon that, why is demand giving a reaction if supply is in control? To generate liquidity and be swept. Or why is supply giving a reaction if demand is in control? To generate liquidity and to be swept. The key to reactionary sweeps is for the initial reaction point to be broken to really be considered a sweep. So if we look at this example, we can see that supply is giving a reaction while demand is in control. And the core reason for this is to create liquidity. So we can see that structurally price is creating higher highs and higher lows. Demand is in control. We have a demand zone sitting right here that we're expecting price to pull back into. And we can see that price creates a higher high and begins to pull back. Price taps into this newly created supply level. We see our initial reaction. We see price then trade lower, come back up, take out the previous high, which creates, in essence, structural liquidity, and then price comes down to tap into demand. We use this liquidity to fuel the move down into demand and trade higher. So in essence, we can view this as internal range liquidity that's being generated to fuel the move into demand to then target the external range liquidity. Now, if we flip that and we see that we are creating bearish market structure, creating lower lows and lower highs, the expectation being a new lower low will form in the market and price will tap into supply before forming that lower low. We can see that when we create the first lower low, we create a demand level. Price taps into the demand, we get that initial reaction, price trades higher, and then we see price trade lower, sweeping the initial reaction, which also forms structural liquidity, and price then trades higher, taking out the liquidity that was generated, the internal range liquidity, tapping into that level of supply, and then facilitating the move to the downside, creating the lower low. Now, what we can do is we can actually combine these two types of structure to anticipate a sweep. So using both structural liquidity and reactionary liquidity together can be a great way to anticipate market structure sweeps. Often a zone will give a reaction, creating a reactionary liquidity, and then go on to break structure. This will then create structural liquidity at the same point. This increases the probability that price will revisit that area of liquidity to fuel the next market move. So we can see in this example, we have a downtrend. We're creating lower lows and lower highs. We can see that supply is in control, and we create a demand zone, tap into supply. Price then comes down with the expectation that we're going to form a lower low. Instead, what we do, we react off of demand, initial reaction, extreme of reaction leg, and then the demand zone fails. So what this also shows to us is the potential of an order flow flip. But when we start to factor in liquidity concepts, we can also see that this has created reactionary and structural liquidity that more than likely can be swept to trade into the extreme supply zone to then carry price lower. And we're able to anticipate that this internal range liquidity will be swept to take price into this supply level to then trade lower. Now, if we flip the situation and look at bullish market structure, seeing higher highs and higher lows and demand and control, price creates a higher high, creates that pullback, taps into demand. Price then starts beginning to move to the upside with the expectation that we'll form a new higher high. But instead, what we see is price interacts with supply, gives the initial reaction, starts to trade lower. See that price creates that extreme of the reaction leg and causes the supply zone to fail, forming a higher high. So if we look at it from a structural range perspective, we're still looking at a bullish structural range between this high and this low. And now what we've talked about in previous order flow flips, we have 2 points. We have the order flow flip from supply to demand, and then we have the extreme demand zone. Because this order flow flip was formed in a way that creates reactionary liquidity as well as structural liquidity, the likelihood of it being swept is considerably higher and will be used as internal range liquidity for price to trade into the extreme demand zone to then create the new higher high. Understanding the different types of liquidity sweeps in the market will allow us to better understand internal and external range liquidity and identify points that have a high probability of being swept so you don't get caught on the wrong side of the market.